Thanks so much, everyone, for coming today, especially with exams coming up. Today, we're delighted to welcome David Einhorn. David is the president of Greenlight Capital, a pre-eminent, value-oriented hedge fund, which he co-founded in January 1996, and whose investment philosophy is to combine the analytical discipline of determining fair value with a practical understanding of markets. And I'm sure he'll tell us a lot more about that later this evening. He's also the author of Fooling Some of the People All of the Time, a long short story, and is a keen poker player, finishing 18th in the 2006 World Series of Poker main event and 3rd in the 2012 World Series of Poker Big One for One Drop. And I'm sure lots of you are here to ask about his poker as well. He graduated summa cum laude with distinction in all subjects from Cornell University. So David, thanks so much for coming today.
Thank you for having me. It's a totally pleasure. I'm excited to be here.
Great. So I thought I just want to start kind of a little bit before Greenlight Capital and back in kind of college. A lot of us here are thinking about our careers. A lot of us are thinking about what we want to do in the future. And you often speak about how much you enjoy your work at Greenlight and how much you enjoy finance. So I just wanted you to tell us a little bit about your path into finance. Like, when did you decide it was right for you? Why did you decide it was right for you?
Great. Well, if you're asking about college, it really had nothing to do with finance. I studied government and thought I would go on to graduate study, maybe in economics or something like that. That didn't pan itself out, and so I found myself getting a job. And so I interviewed with, 40 or 50 different entities in all kinds of different industries that came to campus. And the one that offered me a job that I liked the best was an investment bank called Donaldson, Lufkin, Jenrette. And I took it, and I showed up on the first day, and the first 2 weeks was a training in basic accounting, which was really awesome because I didn't know anything about accounting. So my education literally started on the first day of the job, and then I was in finance, from which I've not been able to figure out how to successfully extract myself.
So you started your hedge fund, Greenlight Capital, just 5 years after leaving college, and you've been there ever since. And you started it with $900,000 of investor capital. I think, again, I speak for a lot of people here in saying that they'd love to run their own hedge fund, they'd love to run their own investment management firm at some point. So how did you manage, just 5 years after leaving college, to kind of raise $900,000, to have the confidence to go do it yourself? And how feasible do you think that is in today's financial industry?
Sure. We left, and I was obviously much younger, and I'd had 4 years of experience, and I'd collected a few bonuses, and I had very low living expenses. I was married, but we didn't yet have any children. My wife at the time had a job, and I'd saved up a couple $100,000, which was way, way more than we were spending on an annual basis. And so I kind of looked at it as like a no-risk proposition. I could start this and it could work out, which would be great. Or I could start this and it could not work out, in which case I could likely try to find a job very similar to the one that I left. And so I just didn't, everyone says, well, how could you handle such risk? And I didn't see any risk at all. There was never any risk of living on the street or starving or having any of the terrible things that can happen to people. And so I just was able to approach it calmly and put my best foot forward and see what happened. And then we had enormous great fortune right off of the bat. And one thing led to another, and here we are today.
So just kind of now moving on to your time at Greenlight Capital. I think if you asked a lot of people on the street, what are stocks that you've heard of? They'd say Amazon, they'd say Alphabet, they'd say Apple. You, however, have typically kind of steered clear of some of these hype stocks, some of these tech stocks, some of these kind of growth names, and instead employing a very value-based strategy. So I was just wondering if you could tell us in the audience a little bit more about your investment strategy and why you kind of like to steer clear of some of these kind of more famous companies, I guess.
Sure. Well, I'm gonna start, unfortunately, by correcting you a little bit.
Sure.
It turns out that for about a 5-year period, Apple was our biggest holding, and Apple is the most profitable investment in the history of the fund. The difference is, though, when we owned Apple, everybody hated Apple. They had come out with their iPhone, and it had a good amount of success, and people thought that this was going to be a one-time thing, and that if you took an iPhone apart into its basic components, the cost of the components was much less than they were charging for the phone. And aggressive companies like Samsung would replicate what they were doing and sell it for a lot less. And Apple's profits would disappear, like what happened to BlackBerry, and that the stock would collapse. And so when we bought Apple, we generally owned it. It was around 8 times earnings or 9 times earnings. And sometimes on a bad day, it was around 6 times earnings. And it was growing at 30 or 40% per year. But people thought it was very temporary. And we argued that the opposite was true, that Apple was not just a hardware company, that it was a combination of a hardware company and a software company. In addition, they had services. In addition, every year, they figured out how to make the phone a little bit more valuable. And then in addition, they added other products. And once you had one Apple product, you'd want more Apple products. So maybe you'd want a Mac, or maybe you would want an iPad. They didn't even have at that point the watch, but lo and behold, now maybe you want a watch, or maybe you want the headphones. And so as these components all work so well together, you become more and more embedded as an Apple customer. And so it becomes a very recurring business. And this was a huge debate we had with the market that lasted for the better part of half of a decade. And so it was exciting to own a famous company, but we owned it at a price that really made a lot of sense to us, where we knew we would do very well. Now, Apple's still a great company, but today it trades at over 30 times earnings. And instead of growing 30% a year like it was when we owned it, it's growing about 0. So it's really a very different proposition. It may be a good proposition, I don't know, but it's not nearly as exciting as it was, in my view, as when we owned it. Our job in terms of finding out things is not to have famous companies or unfamous companies. Our job is to find misunderstood companies where we can have a really big argument with the market, where we think that the price is wrong, not by a little bit, but it's wrong by a lot. And then we put time on our side so that the market has a fair amount of time to sort out our view versus its view. It literally took about 4 years that we held Apple making very little in profit before it really took off, and then we got to make most of the profit at the end before ultimately we sold it, because it was no longer, in our view, misunderstood. We think everybody came to agree with us, and that meant it was time for us to go find the next opportunities.
Great. So in 1996, as I said, you started Greenlight Capital with $900,000. And by 2015, this had swelled into about $8 billion of assets under management, according to some reports online. But then by 2022, that had declined quite significantly to $1.5 billion after kind of few years of difficulty, especially for like value strategies more traditionally. So how do you navigate those often unpredictable highs and lows of investing? Can you give us a little insight into your mindset, and how do you stay rational when investors might be kind of clamoring you to change approach, or investors might be withdrawing their money?
I view investors, I like my investors. I've liked almost all of my interactions with investors over all of the years. They often say things like, "Oh, you're so busy," or "Oh, I need to respect your time," or "Oh, I don't want to ask you these difficult questions." But I almost never mind. I would say maybe 2 or 3 times over 20-something years, somebody's gotten under my skin a little bit, but it's really, really rare. I think they're entitled to their views. I think they're entitled to ask their questions. I think they're entitled to put me on the spot. I think putting me on the spot forces me to focus my thinking and make sure I can clarify my own views. And having to articulate what you think, forces you to sometimes reevaluate what you think. So I find the interaction with them very good. As they had periods when they've wanted to invest, it's been, fun to be able to sometimes welcome them, sometimes not be able to have the capacity to welcome them. Other times when they want to leave, my view is it's not my money, it's their money. And so we have a deal, and it's a commercial arrangement. And when they wish to have their money because either A, they think we're not going to continue to do a good job, or they're angry that we recently did a bad job, or just that they have something else that they want to do with the money that will give them more joy or get them a better return, it's their money. It's not my money, and they're entitled to it. So I never really got all that worked up as we went through substantial amounts of redemptions. So every quarter we would make up a list of stocks that we had to figure out how much to sell in order to fund it out, and we did. And life went on, and I concentrated on trying to be as effective as I could with the capital that we had. And in a career, there's going to be easier times and there's going to be difficult times. And now, having done this for 27 years, we just hit our 27th birthday. I've seen both. And you're not as smart as you seem when things are going great, and you're not as dumb as you are when things aren't going your way. And that's just the truth of it.
I think one of the things that you're maybe most famous for to the general public are some of your kind of big bearish calls on individual companies, most notably Allied Capital in 2002 and Lehman Brothers in 2007. And as a result of these outspoken criticisms, you've often been the subject of very personal attacks from companies and also been involved in legal battles with them. So again, I just want to ask about how you deal with these on a personal level and don't let them impact your attitude to the investment and your overall ability to kind of do your job sensibly.
Yeah. There's been less legal battles than you would think. Like Lehman had nothing. I mean, ultimately I had to give some testimony to some congressional inquiry people after the whole thing collapsed. And I didn't find that very difficult to try to answer the questions as best as that I could. Look, people don't like being told that they're ugly. People don't like being told that their girlfriend is ugly. People don't like being told about their warts, and they react as that they do. And when you call out a company and say, Chef Boyardee appears to be auditing your books, they don't like that. And so you get the pushback that you do. As a general matter, over time, I've come to the view that it's probably not worth it. And in the last couple of years, we've stopped discussing our negative views about companies. We still make the investments against them, but we don't need to discuss it, and it's fine. The market will sort it out, and the market doesn't need us to educate it about what we think about these companies. And so, maybe I've grown up, or maybe I've been punched in the face enough times to change my behavior. But I think this is a sensible way to do it. And when we started not talking about them, they figured it would be a trial basis, but we stopped talking about them over 2 years ago, and I don't really miss it at all.
A key theme in investment management, I think, over the last 15 years has been the rise of systematic strategies. I'm sure lots of people, again, in the audience studying maths or studying computer science, and they're going to work on quantitative strategies in hedge funds, in banks, and even among discretionary managers like you, there's been a huge rise in the use of quantitative models and like alternative data sources to improve investments. So what role do these play in your own investing strategy? What role do they play in Greenlight Capital?
Yeah, we're not a quantitative strategy place. We're trying to start with narratives and find disagreements and misunderstandings. And you're not going to get that off of a screen of multiples or of values. You're not going to get it off of a chart of historical stock prices. You're going to get it about looking at what companies are doing and talking to people and reading and examining what's going on. In terms of alternative data sources, there's people out there that they get the weekly credit card data of all the retailers, and they figure out which 12 of them are doing the best and which 12 of them are doing the worst, and they buy a basket of the better ones that did great last month, and they short a basket of a dozen that did worse last month. We don't do that at all. That's not a way for us to find ideas. That being said, if we have an idea and we want to invest in it, or we are invested in it, we get the data, because you may as well see what's going on. I don't think it's not really driving the initial investment decisions, but it's kind of good to know, hey, sales might not, there's data out there that says sales aren't so good, or there's data out there that says that sales are terrific. And so we incorporate that into our thinking, and sometimes we adjust our positions based upon what we think the data says versus our thesis or what we think other people think the thesis is.
Great. And you've been in investment management pretty much your whole career, apart from investment banking at the start. And again, lots of us, I'm sure, here are thinking about different ways to get into finance, whether that's in trading, whether that's investment banking, whether that's asset management. So why do you think that a career in an investment manager in a hedge fund is a great option for us today? Or would you even recommend it for us?
Well, I don't like to really recommend what other people do. I think it was a good choice for me. And I think that the advice I give to young people, including my own kids, is what you really want to do is figure out what your strength is. What is it that you're good at? What is it that's easy for you? What is it that you think you're better at than other people? And then fashion your career that plays to your strength. That you can have weaknesses in your personal life. If you're, a slow runner and you want to work on running faster, God bless you, or your hobbies and all the rest of it. And if you feel like, you have, say, like poor interpersonal skills, you can work on your interpersonal skills. But if you've got poor interpersonal skills, don't be a salesman. That's poor. That's a poor choice. But if you're really strong that way and you're weaker quantitatively, then be a salesman, because that's going to play to your strength. And so each person has to be self-aware enough to realize what it is that they're good at, and then find a career that plays to that. Because if you play to your strength, you have a best chance, I think, to distinguish yourself versus other people who you're going to be competing against in whatever field it is that you choose.
Before I move on to audience questions, I wanted to quickly pivot away from finance and Greenlight specifically, and move a little bit onto your interest in poker. So as I mentioned in the introduction, you've had some success on the World Series of Poker, and you're a very keen player as well. And I think it's true that a lot of finance professionals, there are lots of examples of finance professionals who have a very active interest in poker. I guess the ones that come to mind are Bill Perkins, Steve Cohen. And I was just wondering if you could tell us a little bit about the overlap between finance and poker. Why do you think it's the case that so many finance professionals enjoy poker, and some poker players are also good at finance, whatever that means? Where do they overlap?
Sure. Look, there's some overlap in the skill sets. Like if you just think about an investment versus a poker hand, there's some information that you know whatever the historical facts are, or in a poker hand, whatever cards you can see. And then there are things that you don't know, but you can surmise. When this management answers this question in this way, what are they really telling me? Which may be different, particularly from the verbatim. When your poker opponent bets a certain way, what can you surmise about what he is doing? And then you have uncertainty. There's going to be future range of outcomes, and knowing what those outcomes are and how those distribute, and then how those might affect the outcome of your decision to bet or fold or invest or not invest. You have to kind of think that through. And then over time, the uncertainty resolves itself, as certainty, and then you get an outcome. And then the other thing I would say that is somewhat similar is you have to have a temperament, because you're going to lose a lot of poker hands and you're going to be wrong in a lot of investments. And how you ride things when things are going your way, and how you handle setbacks in an emotional way is a skill. And it's sort of, there's a phrase in poker, being on tilt, which is where things haven't gone your way, so you start making worse decisions. Like having not much tilt is a big plus, and it's also true in investing, because sometimes things are just not going to go your way. And what do? Do you double down? Do you make your investments bigger? Do you cut your losses? How do you risk manage things when things aren't going your way? And so there's a fair amount of overlap in some of the skill sets that are needed for both of these things.
Outside of finance and away from poker, you've also been involved in a number of philanthropic projects, such as the Michael Fox Foundation, the Robin Hood Foundation. In 2011, you were involved in a potential purchase of a minority stake of the New York Mets as well, and you've also donated to a number of political campaigns over the years as well. So could you tell us a little bit about some of your projects that you do away from Greenlight Capital? What motivates you to get involved in them, and what does the future hold as well, especially if and when you retire?
Yeah, I came to the view relatively early on in my life that it was important to be generous and to help, and that there are places where you can help and there's places you can make a difference. And I know that there's some that would say or have said, And it was also clear to me that I was going to be fortunate enough to probably have, more resources than I would ever be able to consume or use for my own purposes, kind of no matter what I did, which is extraordinary good fortune that has come my way. And I feel very lucky about that. And I think if you early in my career, it occurred to me like helping now is probably at least as important, if not more important, than helping later. There's some that say, well, I can compound money at a really high rate of return. And so if I keep all the money for now, I can give it away much more at a later time in life. But I think the problem with that for me was, first of all, it's not so certain what that compounding is actually going to be, even if you have a lot of confidence and experience. And second of all, problems today are more important to address than problems in the uncertain and very distant future. So it made sense to kind of get going relatively early on. So I've been maybe 20 years or so since I've had really an organized plan to do philanthropy. And it's evolved. I have a team now of, I think, 7 full-time people helping me figure out what to do. We have an organization, we call ourselves the Einhorn Collaborative. And what we're doing is we are addressing basically, I've sometimes called it helping people get along better. Sometimes we call it bridging and bonding and building, because those are 3 nice little B things that go together. And what we're really trying to do is address some of the problems within society that are addressable simply by people doing a better job being people. And so we work on helping mothers bond with their babies, which is fantastic, because if you can create a co-regulatory positive relationship near birth time, both the mother behaves in a certain way over time and the child learns what a regulated relationship feels like and is then able to translate that into other relationships that they have throughout their life. The studies on this are actually pretty incredible. Another area that we're presently very focused on is an entity that actually we helped found, which is called the New Pluralists. And pluralism is basically the view that different people can have different views about a lot of things, and we can argue about things, and we can disagree about things, and it's going to be okay. And we can tolerate all of this and accept all of this and work within. So what we've done is we've organized philanthropists that are across the political divide. And I mean from all the way from the far right to the far left, plus also a whole bunch that are in the middle. And what we've done is we've figured out, let's pool resources and work on things that we can work on together. And there's a positive just in getting all those people into the same room, because a lot of times they don't want to talk to each other and they hate each other over this or that or their political views. And if you can get the people as far on the left as we have and the people on the right that we have all together in the same room, you've already accomplished something. Because then once they start working together, they actually realize, look, we have different views as to how to go about it, but we're all actually trying to make progress. Like, nobody is donating money to things because they want to make things worse. They just might have a different view as to how to go about that. And then what we've collectively decided to fund are a bunch of organizations that are in the field already. We call the leaders of these field builders that are already working on bridging differences across the population. And this is a huge problem. You may not have this here in England, but the United States, we're a very divided country right now, culturally, politically, and so forth. And so we are working with organizations that are helping try to solve or improve the conditions between people who have different views and different backgrounds and philosophies. And there's lots of examples of how this gets done. None of them are individually leading examples, but we're literally fielding hundreds of efforts that are going about doing this. And this is something we're hoping becomes much bigger over the next number of years. It's been an exciting project. We're about 3 years into it.
Fantastic. I think we've got plenty of time for audience questions, and I think straight to David at the front.
Thanks so much, David, for your time. I'm also David, and I saw you drive a Honda Odyssey, and just kind of building on what you kind of mentioned about the importance of service and giving back in community. I'm just wondering, what actually grounds you over the years, and how has that changed?
Honda Odyssey story has probably been blown dramatically out of proportion. But it's true. When and I don't drive one now. My kids are grown. But when at the time, the Honda Odyssey was one you could push the key button and the door would slide open. And when I had three children at the time, and when you had children and you were shopping and stuff like that, being able to push the key and have the door slide open and be able to have everybody just run into the car and then put whatever you're shopping for in the way back, it was super functional and convenient. And so I couldn't imagine why I would want something else if I was, taking the kids to the store or something like that. And so, I don't know, I'm a practical person in that way. But, everybody, I spend money on things much more extravagantly from time to time as well.
Just sit back over there.
Did you ever have ESG factors into your process? What are your thoughts about that? And have your thought process changed over the years that it has become more mainstream, more limited partners maybe want to have that as part of the process?
Yeah, my philosophy is to set up our investment pool the way that makes the most sense to me. And so we really don't cater things to what we perceive the desires of the limited partners to be. So it's more like, this is what we do, and if it makes sense for you, you come and be part of it. If it doesn't make sense for you, then don't be part of it. Go do something else. Like, this is a voluntary exercise to come and invest with us. I do have a view about corporations and what they should be doing. And there are some businesses that I think are so socially repugnant that I don't really want to invest in them, even if the economics are good. I'll cite payday lending as an example of that. And there are some corporate governance things that I think make certain companies more or less uninvestable. And in a few cases in the past, we've invested in companies with difficult corporate governance situations, and it's a real headache. And so we try to avoid those kinds of things. But we don't look at third parties to assess ESG because we don't think that they do a very good job of it, and we don't necessarily have the same opinions as they do as what good E, good S, and good G are, and what the weightings between those ought to be. So I would say I give some thought to how companies behave and what their role in society is and what their function in society is, but I may come out with conclusions about that are very, very different from what institutional shareholder services scores something on an ESG basis.
Thank you so much for your talk. You talked a bit earlier about your perspective on risk when you were starting Greenlight Capital. And I was wondering if you could talk about how and why you thought you personally would be successful in starting this company, and what would differentiate you from the already very large hedge funds that already exist.
Yeah, I thought we would be successful because I thought I had some good training from my prior job, working only for 2 years, and I recognized that at the very beginning nobody wanted to invest with a 27-year-old with no experience, and it was going to take some time to build. But I thought I understood what we were doing well enough to try to do it. And I didn't know that it would succeed, and I wasn't overly confident that it would succeed, but it seemed to me that we had a very good chance, and it was worth trying to do. So we did, and it worked out. It's a kind of a lame answer, but that's kind of how it was.
Hi, Andy. You said that value investing is declining in terms of being practiced with the growth of index funds, yet the opportunities are growing. So why do you think that is, and what's your view over the next 10 years for value investing?
Yeah. I think that value investing, by which I mean analyzing companies, trying to figure out what they're worth, and then trying to buy them for less than they're worth, is something that was a very, very common practice when I started in the business, and now it is a very rare practice. The reason is so much of the money is invested in ways that valuation or valuing companies is not a key component of the investment strategy. If you're in an index fund, it's not at all a component of the strategy. You're assuming the values are already correct, and you're going to pay them. You're going to buy the most of whatever the most overvalued thing is, and you're willing to live with everybody else's decision. These other types of quantitative and systemic strategies are generally not analyzing companies off of their fundamentals. They're making other types of guesses, correlations, historical trading patterns, and so forth, trend following. None of these are valuation sensitive strategies. The amount of money that has come out from active managers charging fees to analyze companies, and I don't mostly mean hedge fund managers, I mostly mean long-only managers, and be replaced by indexes at much lower fees, and then even within the active management, having the fees cut dramatically means that the research staffs at these places have been cut dramatically. So the number of people that are actually engaging in this process is much, much less than it was. And to the extent there are people, they haven't been rewarded with capital to deploy into the strategies in any case. And so if you don't have money coming into the strategies, it doesn't really create competition. And so for me, I actually think this is a very good situation because you have lots and lots of capital trading every day that has nothing to do with valuation, causing enormous discrepancies between what things are arguably worth and where they happen to be trading at the moment. And there's much less competition for us in identifying and capitalizing on these opportunities. And so I kind of feel like the absence of competition sets us up as maybe one of the few survivors of the bloodbath that has happened to active management over the last decade. I think it positions us in a very favorable spot compared to when there seemed to be thousands of people trying to do the exact same thing that we were, and we just had to do it a little bit better than them.
So if I could just jump in there, I was just wondering, given the amount of money that's shifted into index funds, that shifted into hedge funds that operate systematic kind of trends following strategies, how has that changed? And obviously that's had a huge impact on the market. How has that changed what you see as a value investing opportunity? Do you now not invest in certain things that you might have done in the past because of the market dynamics, or are you kind of independent of that?
It does change things, because the question is how are we going to make a good return for our investors? And I wouldn't characterize this way at the time that we were doing it. But a long time ago in the business, what our job was to figure out what the really big long-only institutions were going to do 3 months, 6 months, 9 months, a year before that they did it. So we would look at spin-offs. Spin-offs were great. They were spun out. Nobody wanted them. They were often sold. And the people who might want to buy them in the future often took sort of a wait-and-see approach. Oh, this is a new thing. Let's see how the story evolves. Let's see what 3 months looks like. Let's see what 6 months looks like. If we could figure out ahead of time what those things were likely to look like, and in the way that was going to trigger them to want to buy the stock, we had a nice window to buy when nobody wanted to buy. And then you wait 3 months, 6 months, a year, something like that. If the story played out the way they did, then these big institutions would come in and they would buy the stock, and they would have money coming in every day, and there might be several of them at the same time, and the stocks could go up an awful lot relative to our entry price 6 months earlier, a year earlier, something like that. And that was really the bread and butter of our strategy. I wouldn't have characterized it exactly that way at the time, but in hindsight, that's what it was. And now, if those institutions aren't there anymore, and they're not looking at that stock 3 months or 6 months or 9 months from now, and even if they do, they don't have any new money to put into it in any case, because they don't have daily flows coming in. And in fact, they have redemptions, or they have to sell something to buy the new thing. They're much less likely to decide to buy whatever this new stock is. So if we used to want to pay something, hey, this is a pretty okay company, we can pay 10 times earnings, and the earnings will be 15% better maybe than people think, and then people will say, wow, this isn't as bad as we thought it was, so it should be at 14 times earnings. Well, you make 60% over 2 years when that happens, which is just a great return, actually with very low risk. But if you do that now, you're going to get to the 2 years, and the earnings are going to be 15% higher, and the multiple might still be 10, or it might have shrunk to 9, or something like that, and maybe you break even, or maybe you make a very little bit of money, which is not an exciting rate of return. So we can't be in that game anymore. The good news is because so few people are now actually paying attention to values in the unliked parts of the market, you can buy perfectly reasonable enterprises at 3 times earnings, at 4 times earnings, and at 5 times earnings. So we're compensating for the fact that we don't know who the next buyer is going to be by paying maybe roughly a third or half of the price that we used to pay, which gives us both a theoretical margin of safety, but it creates a second opportunity, which is if the investors don't figure it out, the companies can do it for us. So if you buy a company and it doesn't have any debt and you're paying 4 times earnings, it means you're getting a 25% earnings yield. And if the company takes that 25% and buys back its stock, now a quarter of the shares are going to be gone. Now let's say the stock still doesn't go up and they do it again. And let's say another year goes by and the stock doesn't go up and they do it again. And then another year, and the earnings aren't even growing. And you have one more year and they do it again. Well, guess what? They've just bought back 100% of the stock. And now you only own the last share. So it becomes a math exercise as to when the number of shares gets so small that it just has to go up because there's nobody left to sell it. And I think that's a super exciting investment proposition that's actually way easier than trying to figure out if the company is going to do 15% better than what everybody thinks. In this case, if the company does 15% worse, it's not that big of a deal because instead of it taking 4 years for it to retire all the stock, it takes 5 years or 6 years. And either way, you're going to make a terrific result. And that's why I'm so excited about the opportunity set that we have now in this broken environment. I consider it sort of a broken environment in the sense that there just aren't a lot of people with capital that are even analyzing these things to try to figure them out.
Sounds like Buffett's comments about it's better than Viagra investing during the stock market was. You don't have to comment.
I don't know the comment.
Ask me another question. Homestead International, Deli in New York, with one of the most outrageous valuation works. Do you want to talk a bit about that?
The Deli?
Yeah.
There's not really all of that much to say about it. It turns out the whole thing was a big fraud. I didn't know that at the time. Somebody I know just pointed this out to me, that there was this publicly traded company that owned one deli that had about $20,000 of sales, and it was losing a little bit of money, and it didn't have any clear capital or expansion plans, and somehow it had found its way to being listed on the public markets and was trading for around $150 million. And I pointed this out just as an example of what the heck is going on here. And for whatever reason, it seemed to capture a lot of people's imagination, including, believe it or not, the authorities. And they investigated and found that the whole thing was just a big fraud. And I think now they've arrested a bunch of the people who were involved with it.
And you never actually ate them?
I didn't. Jason, who's with me, actually visited, and he went there and he got the sandwich and stuff like that, and gave a report. And what I can testify is that the chips that he bought at the deli were past the expiration date.
I think you've got a question right at the back.
Hi. So you talked a lot about your career, and I'm sure throughout that probably has been ups and downs in the fund itself. But what would you say the highlight of your career, and is it necessarily correlated to when the fund was doing best?
Yeah, I don't think there's a highlight. I don't think I can say that. There's been so much fun. And for me, I actually think the most fun is when I'm sitting there and the light bulb goes on and I think I figured something out. And sometimes that's just like a private moment. And I'm like, oh wow, look at that. I really figured this thing out. We're gonna do great here. And it's more exciting often to make the investment even than to watch it work. So I'm sorry to duck that particular question, but it's been a phenomenal ride for me, and I've enjoyed so many parts and so many of the people and so many of the experiences. I mean, just getting invited to come and talk to you today, like when I was sitting in your seat at Cornell, I never would have imagined, being here today, having the privilege and opportunity to answer your guys' great questions.
I have a question. As you mentioned that you guys don't rely on the third-party service for evaluation for the assessment of companies and stuff, and the way the things are evolving in regards to artificial intelligence and data analytics, many companies are relying on notes of the data.
And like the way predictions are happening with regards to the market, and so there's so many tools and technologies which can help you in analyzing what's going to happen in next 5 years, what's going to happen next 2 years, the stock prices and stuff. Does these factor influence your investment, or you still stick to your traditional back-to-back investment?
I'm sorry, I didn't understand the question fully. What factor impact the investment?
So, like, I'm talking with regards to artificial intelligence and machine learning. Like, you can always consider different parameters which can kind of like make this investment valuable or not. So you can make your investment pretty much data analytics based. Many businesses are relying on these sectors and using tools and technologies for all these sectors. So you still rely on these, or you follow your main approach?
Yeah, we're not, to answer your question, we're not going to out-computer science the computer scientists. And if we have to compete to machine read 10Ks faster than we can read them with our eyes, or other types of algorithmic programming, that's not going to play to our strength. So we have to figure out what does, it comes back to even what I described before in terms of telling people what they should do. There's lots of good ways to invest. We don't have the only good way to invest. We have a way, I think, that makes sense to us, that we're capable of executing on. And I think on balance has been successful much more than it's been unsuccessful. And as I look at the landscape right now, I actually think it's more likely to be prospectively more successful than it has been over the intermediate past. Like, I don't believe this is a bad environment for what we're doing. But that being said, there's always been, and I think there's always going to be, other people with other strategies. I remember when we first started, very, very first started, all the way back in 1996 in our first office. We were given a little closet, basically, by our prime broker, and there were 5 other funds that had equal one office spaces in our little suite. And one of those guys, they were computer programming, and they were back testing, and they were going to, make all of their money through their quantitative strategy from whatever. It wasn't machine learning at the time, but they were going to, program in stuff that was going to lead them to have great returns. And I'm sure that they did, or maybe that they didn't. I never really heard what happened to them. But competition from this sort of thing, it's always been there, at least in my career. And I think it's always and I think it always will be. And in some ways it will probably get tougher, and probably has gotten tougher. But I think we have a couple things that actually play towards our strengths as well. One of which is that we often, almost every one of these types of program things and machine things doesn't have the patience that we do. You're not going to invest in a machine algorithm. A lot of them are designed to try to make money every single day, or every single hour of every single day, or do lots and lots of tiny little trades where they're right 53% of the time, but they're picking up pennies all over the place. That's how I perceive most of those things. I think they have very little ability to say, this stock is misvalued by a large amount, it's going to do great over the next 3 to 5 or 10 years, and has a very favorable risk-adjusted profile, and we're going to buy it at this price right now and watch it like crazy, but more likely than not just kind of sock it away and see how that goes. I don't know how the machine learning people are going to get to take that away completely. And so I think we have a place in the world, and I think we have ability to compete. And actually, as I look at the landscape right now, I actually think it's more favorable probably than it was 5 or 10 years ago.
You just get that.
So, hi David, nice to meet you.
Nice to meet you.
I'm Nick. So, one question I have related to Greenlight specifically, and asset managers with your type of long-term oriented value strategy. Do you feel that active managers, that permanent capital, such as owning a reinsurance company or a bank, is a key component of success on a go-forward basis for today's asset managers?
Yeah, I think my view on that's changed. We actually started a reinsurance company and part of the thesis of the reinsurance company was to have permanent capital. And upon reflection, I don't think it's necessary at all. I do think you need to be able to match your capital to your liquidity to some extent. So you can't buy private investments and give people monthly redemptions. There's some real estate funds right now that bought private real estate investments and offered short-term redemptions, thinking the investors would never actually ask for their money back or something like that. So if you have that kind of a mismatch, you can create a real big structural problem for yourself. But we're basically investing in publicly traded securities. And if some investors want some of their money back, we reduce our portfolio. And it's liquid enough, and we can manage it well enough. I don't think it's a real harm to what we're doing to, from time to time, have to give some of the investors some or most or all of their money back. I just don't think it's that big of a deal. And so if I had to do it again, I think I would skip on trying to figure out how to get permanent capital, and I would just try to focus on making good investments. Sure.
We just go over here.
Hi David, thanks for taking the time. I'm Matt. So I was just wondering, what was your outlook on Tesla, considering it's been suffering quite a lot recently? So.
Yeah, I think I mentioned recently, as in about 16 minutes ago, that we're not really discussing our short positions. And that's going to extend here. I would profit for you if I wanted to. I could take the balance of the time and then another hour at dinner and explain to you everything that I thought about Tesla. But I'm not going to do that. So we'll just move on to the next question, if that's okay. Sure.
Just there.
I'm wondering sort of what your role in the company is now, besides focusing on the product. You focus on HR strategy, marketing, and how maybe your sort of day-to-day responsibilities in the company as a founder you have changed over time since you founded it?
How have my responsibilities changed?
Yeah, sort of what agenda is under you and what do you sort of outsource to others?
Somebody asked before, I think you asked before about starting and stuff like that and whether it was possible to start, and I think I only answered half your question. When I started, I mentioned we were in a closet, and I was there with a partner, and so it was two of us. And that meant that somebody had to do everything. And that meant that somebody had to get lunch, and somebody had to file the papers. And when we had to send faxes out, and we sent faxes those days, it was way before email. I think we had a shared email account when we started. And it was a big deal when I got my own email account, so my partner couldn't read all my email. I had to stand over the fax machine and fax out the results every month. And it was a pleasure and an honor to get to do that. And when we made brochures, somebody had to go to Kinko's and make the copies. And I did that too. And so, my need to do all of the jobs, it's been there since the very beginning. As I've been blessed by being able to have enough revenues to eventually be able to hire people to do some of the jobs, well, that's been sort of a relief, right? Because some of those jobs are less fun than others of those jobs. When we started, I always thought it was very important for us just to keep our expenses low, because if you keep your expenses low so that you're not losing money every day by having expenses more than your revenues, time is on your side. And if you have expenses higher than your revenues, then time is against you. And life works much better when you put time on your side, so that every day you're just trying to do a little bit better than before. But if today is a setback, it's honestly not that big of a deal. So over time, we hired people, and they do all kinds of jobs. And I now have 31 people working at Greenlight with me. And there's lots of jobs that maybe I had to do in 1996 or 1997 that I don't have to do anymore. And I'm lucky that I don't have to do them, and I can have other people do them. What I wind up doing is spending most of my time, as I always have actually, on the portfolio. That's my main job. As you hire people, you have to manage them. And so that's also a job. And so I have to manage people. And I've always had a role in marketing and customers, because customers always want to meet the portfolio manager and hear what it is that the strategy is and ask them their questions and, see what happens when they meet them and how they react to whatever it is they want to see. And so we've always had to do it. It's not been a big use of time. Like, I don't spend much of my time meeting investors and marketing, but it's something I do on a continuous basis. So in a lot of ways, my job only seems to improve because I get to have other people do the parts that I don't really want to do as much, and I get to focus more and more on the parts that I like to do. Although obviously every job still comes with parts you don't like to do. And so when you are running a company and something happens and there's something that's particularly unpleasant, sometimes you have to do that yourself too. And I think that's just kind of the nature of the job that I have. So it's not all fun and games and joy, but it's a lot, and I'm very lucky.
Just go right at the back.
Yeah. Sorry, I'm not sure if you have talked about this before, but I read your recent paper on free peanut butter. So if you can maybe talk more about that, about what's happening in that space, companies are trying to transition to.
Sure. Last week, I gave a presentation at the SOAN conference. For those that don't know, it's an annual conference, historically live until COVID, in New York, and I've been privileged to be part of it for most of the last more than 20 years presenting. This year's presentation was a virtual presentation, so you can actually find it on our website at greenlightcapital.com if you're bored, and it was entitled Free Peanut Butter. And what I did was I took this company called the Telesco, which was a part of Continental. It was spun off about a year ago. And what it is it's basically their powertrain and controls business. And they do this for ICE vehicles, which is kind of their historical business, but they've also developed substantial expertise in the technologies that are going to go into electric vehicles. And I basically said that if you viewed the historical business as chocolate and you view the electric component business as peanut butter, because they're really very different. The historical business probably has very low growth. It has good profitability. It will continue on for a lot of years. But it's probably, it's not the most exciting business, and it'll generate a bunch of profits and cash flow. But the electric business is likely to have a tremendous growth because the world is determined to convert most of the new car sales over time towards electric. And these guys have a really great competitive position there, so there'll be a lot of growth. So I called that the peanut butter, because you put it together and you make a Reese's peanut butter cup. So in one company, you kind of have like the old business and the new business, and you put it together and you have a really, really cheap stock, because most people seem to think of it, I guess, as the historic business, because the electric business doesn't yet make a lot of profits. But as you see what they've earned in terms of new orders and what's going to happen for them over the coming half decade or so, they're going to have enormous growth in revenues and profits. And so you kind of have a really sexy business, which is the peanut butter, all combined in one stock. And that was the presentation that I made last week. And the thing is due, I believe, to either the presentation being very poor, or there just not being any active managers assessing values with capital to deploy into new ideas, or maybe nobody watched SOAN this year because it was virtual. I don't really know. The stock really is about the same place as it was when I talked about it a week ago, and it's likely to remain so until it becomes much clearer how the trajectory of the company is going to perform. You just want the peanut butter. You don't want the chocolate. It's really funny. My dad called and said he only likes the chocolate and he doesn't like the peanut butter. Do I see any other peanut butters? Yeah. Like just really exciting, growthy kinds of things like that?
Because if you don't care about specific companies, what sectors, like one is automobiles, 20s, and...
I really don't know how to address that. We have a portfolio of companies, and I think all of them are misunderstood and misvalued. Some of them have great growth prospects. Some of them have lousy growth prospects, but they have very good returns of capital. And so, it's kind of a mix. The most exciting thing I have in my portfolio from my perspective is the company we founded and is publicly traded called Green Brick Partners, which is a home builder and real estate developer. The company's done extremely well. If you look at the stock price lately, it's just had an extraordinary period. But I think we've actually built a really, really exciting company that is beginning to differentiate itself from its peers. It's really probably taken 15 years for people to realize that our strategy actually is differentiated, and that's beginning to come out. And it's exciting now, not just working on the business all the time, which I do as the chairman of the board, and I speak with or email or text with the CEO. It seems like almost every day about what's going on there, and it's really been just a fun experience, because I think it's just beginning to show how baked it is, and I think we really do have a superior business proposition and execution to most of our publicly traded peers, and so that is certainly a highlight of the current portfolio.
I think we've got time for one more audience question. If I just go there.
So I kind of wanted to ask, what kind of information do you think contributes the most to your investment process? Is it more like the public information available, or something like the publicly available information, or the information that you acquire, or is it more when you talk to people or study, like go to talk to people about businesses? Is that what contributes the most?
You know, I view each investment as its own puzzle. And so I don't think there's a cookie cutter way to figure out, well, what's the most important piece of information for all investments. I think it's better to say, this is the investment proposition at hand in this particular opportunity. What is it that I need to figure out about it? And that might come from reading documents, it might come from talking to people, it might come from research, it might come from doing calculations. It can come from any number of places. And so the goal is to figure out what is it we need to know, figure that out as correctly as possible, and then decide if there's an investment to be made as a result of that work.
I think one last thing from me. I think a lot of us here are thinking about kind of going into finance. We might be applying for internships, we might be applying for grad jobs. If there's kind of one thing that you could change about the start of your career, whether it's going to a different company, maybe it's not doing investment banking, what would it be?
One thing I would change at the start of my career, I mean, look, the investment banking 2 years was a very mixed thing. I'm pretty sure I wouldn't have gotten my next job if it hadn't been for the first job. I was recruited by a headhunter, and the headhunter knew to call people who were working at the bank that I was at, and if I wasn't at that bank, I wouldn't have found it. That being said, I found my experience in banking for 2 years to be easily the worst 2 years of my professional career, and it's not something, if I had been told up front that was what that 2 years was going to be, but it would lead me to a good place broadly defined, I would still skip it. I'm not sure I would skip it if I knew it was going to lead exactly to where we are today, because overall things have worked out so splendid. I wouldn't change a thing. But I did find that 2 years to be just particularly miserable, and it's not something that I would wish anybody follow. Like, I thought it was completely unnecessary.
Cool. I think that's all we've got the time for today. So thank you so much for coming to speak to us. I know there are lots of questions still to be answered. I don't know if you've got any time after this to quickly chat to people, but thanks so much for coming in.
You're very welcome. Thank you.